Good afternoon, everyone. Good afternoon, Tim.
Hey.
Without further ado, I guess well, that's been sequestered.
Yeah.
Yeah, but that's, are they going to have some, are we going to have some solstice bonfires here in Boston tonight? Because down in Washington, we're thinking about having one up on Capitol Hill. In any event, welcome.
Thank you.
I think it probably doesn't violate any journalistic restrictions to say that you're heading a company that is a success story, a true success story in the industry, and I think it doesn't violate any journalistic problems because it's quantifiable. I mean, it's founded. You founded it. You took it public. You got customers, revenue, and a stock symbol, and some longevity to you, which I think right there gives us some things we can work on. So work with in terms of an interview. So tell us what you learned that you shouldn't do if you had it to do again, the process of taking a company from a concept to a exchange-traded business.
Yeah. Well, I think we're still learning every day. It's still a new frontier for us. I think you look back in the early days. One of the first things I learned in those first 5 or 6 years was that to make sure that you spend as much time as you possibly can hiring the right people. I think if I look back on the folks that we hired that were some of the great hires, they wound up being hires that I think our team was extremely deliberate about. We spent a long time getting to know those folks, and then recruiting them was a long time, and we stayed patient with them. I'm thinking about one of the first MBA interns we hired. We got to know him over that whole summer. He's now a senior vice president of finance. We wanted him back, but we got to know him. We kind of took our time. If I think about my senior vice president of sales and marketing, I recruited him for well over 15 or 16 months before we got him on board.
What was the challenge in bringing him on?
The challenge was what I think a lot of these companies face, which is it's pretty daunting to leave. He was leaving a big company, Hess.
Sure.
He was working for a big company. He'd worked for Crayola. He'd worked for a consulting firm, all very stable companies, and he was thinking about his career. And
so what finally brought him over? What was it? Was it mercantile, or was it? Did you inspire him in some other way?
I think there's a saying: you usually don't quit your company, you quit your boss. And if I were to guess, when new management came into his firm, I think he thought it might be time to find a new frontier and a new opportunity, and he did. And I think the converse, there were some folks that we were very quick to hire because we felt like we really needed to fill that need, be it a development need, an engineering need, one need or another.
Right.
But I think that was one of the things. And then the thing I learned in the last 5 or 6 years, because we've been public now for over 6 years, is sometimes I have to separate out the company from the stock. Investors buy stocks. They don't necessarily buy the company. They buy things on, will this stock move? Is there some catalyst, some event that's going to make the stock move? A lot more than the health of the company is moving on any day.
Sure.
There's nothing on a single day, most likely, that's going to increase or decrease our market cap by $150 million or $250 or $300 million. And yet we've seen our market cap just in the past 2 weeks has gone down by a couple $100 million. And in the first couple of months of the year, it went up by $200 or $300 million. That's
so you got to disassociate
the
stock behavior from the business behavior. Well, it sounds like, speaking of stock, you have put a lot of it into your people. And that raises a question about being located in Boston and in New England. The lore is that has very strong advantages just because of the wealth of education talent here. And capital. Has that been your experience? I mean, do you think that it was necessary for Enernoc to be located in New England in order for it to have been where it is, or could you just as easily be out west?
No, I think we've been a lot better off by being here in the Boston area. It was a very conscious decision because when we got started, it was just David Brewster, the co-founder of the company, and myself. We had just gotten done with our graduate programs. We were in Hanover, New Hampshire. We knew that probably wasn't the right place for us to start our company in particular. And we were looking at places where you had access to talent, particularly software development talent, because we knew what we were developing was going to rely most heavily on software development. And sure enough, now we have over 125 software developers and more control systems engineers. But if I think about what Boston is good at, what this region, the New England region in particular, and more specifically Boston and the 128 area, we're pretty good at, I'm not sure we're the greatest at consumer products. I'm not sure we're the greatest at some of the things that Silicon Valley is very good at. What I do think we're really good at are solving hard, complex business problems that require robust technology solutions. Business-to-business software and business-to-business technology solutions have been very good. You look at the CAD/CAM software market. We have some of the leading names here in companies like SolidWorks. It's now part of Dassault Systems, Parametric Technology Corp. You look at our software ecosystem, and we do very well in the business-to-business software ecosystem. We do very well in the big data software software area. And I think what the smart grid is, and what our particular play in that market is, it relies very heavily on robust systems and scaling of big data sets and big information and information technology, and then connecting the supply side to the demand side. I don't think hype wins the day in our particular industry. I think we're good. New England is good about show me, prove it to me. Prove to me that this software really works and it's going to solve my particular business need. And I think we've done well in that realm.
So what are you looking for, or what has worked for you for Enernoc in terms of partnerships? Whether, I guess particularly I'm talking about product development. I mean, do you rely on partnerships to any significant degree for product development, or is it mostly an in-house exercise? And how would you characterize the future path, the future direction of partnerships for your company?
Well, I think they've always played a quiet role for us, not one that we've hyped a lot, but somewhere between 15 and 18% of our sales have been through partnerships since the company's inception. These are partnerships with other energy consulting firms, energy advisory firms, supply side advisory shops. Is that like a
white label kind of a product that you're supplying?
No, we're just, in those particular instances, we have a direct sales force, and we like to leverage other entities that have business relationships. So you're talking about the ABCs, the advisors, brokers, and consultants that are helping commercial industrial customers buy energy more cost effectively. And there's literally hundreds of these smaller entities that do just that, because it used to be that you didn't really buy your commodity supply in any meaningful fashion. But now, with regions like New England with a competitive wholesale market and competitive retail opportunities in various states in New England, in Texas, in Pennsylvania, California at times has had robust opportunities for competitive retail supply. So we've partnered with those guys. But I think, to your question, product development and developing actual product, more so than ever before because of what's going on. I think that there's a second generation of clean energy or energy data startups, and I see them here in New England. We have some with some great technology that's come out of some Boston universities, and some folks that have put some businesses around that have their, when we started working with them, they had just hired their 15th employee. Wow. It's a year later, and they're on to their 50th employee, and so clearly there's some things going right with these companies. But these are data analytics firms, companies that are leveraging the massive amounts of energy data that we're just starting to get our hands on. And I think that's what the last 10 years have created, is an enormous new wealth of important energy data that needs to be mined, and mined in a way that's going to create meaningful value for the commercial enterprise, for the utility, for the grid operator, the system operators, and so forth. And I think that's a lively area for investment, and we're seeing it. We're seeing the same VCs that said no to Enernoc, 36 different firms. Many of those firms aren't saying no the second time around as we see those new companies come through.
Well, of course, saying yes, getting to yes, if you will, is what I think a lot of entities, startups, and even advanced but pre-public companies would like to do. So, any advice, just off-the-cuff advice for helping them get to yes?
It's probably the same advice that we've said for years. I think the two things that mattered to Enernoc was or were the team was one of the most important things. Putting that right team together and making sure that your investors could appreciate, or your prospective investors could appreciate, why those were the right people, what roles they were going to play, and that they had the tenacity and the relentlessness. We talk about 3 things when we bring an Enernoc person into the fold. They got to be bright, relentless, and good. And it refers to 3 different, characteristics. Bright is obvious. You got to have the intellectual horsepower, because this is a complex industry with, politics and regulation and just the complexity of these markets. You got to be relentless, because you're going to get rejected an awful lot in any startup, but certainly in this one, there's big barriers. And then good is, hey, if you're going to be working 80 to 100 hours a week, you're probably going to spend more time with your colleagues than you are with your family. So pick your colleagues like you're picking your family members. Try to find good people that care about the mission that you're after, people that care about working in a collaborative environment. That's the number one thing. And then the second thing is, it goes back to that middle trait. The relentlessness is what the entrepreneur has to have, especially now, because look, it's not as easy to get funding. There are fewer sources. The capital has shrunk to a certain degree relative to where it was just 5 or 6 years ago. Doesn't mean it's not still there. It doesn't mean it's not going to increase in the future, but it's a scarcer pool of resources, and there's a little bit more selectivity because some folks are nervous about their experience with it. And I think you got to be even more relentless than ever before. And it probably brings us back to the time that when we were raising money on the heels of the internet bubble, the .com crash.
Yeah, I mean, it was I think everybody would agree it's a very different time now. Nevertheless, you got your challenges, no question about it. Let's talk about a current one, which is your stock prices. It's probably safe to say that it's not where investors would like to see it. And more directly, the recent auction in the PJM market, which is your major market and major customer, actually brought prices of what you do down when everybody would like to see them be going in the other way. How do you manage that? And I guess really, let me be more blunt about it. What does this say about the business model of Enernoc from this going forward?
Sure, a couple things. It's clearly important to keep everything in context and keep it relative. But it's also important to recognize that Wall Street is about what have you done for me lately, not what have you done for me in the last year. Because in the last year, the stock is up 100%. The problem is it got as high as $19 just 4 or 5 weeks ago, and now it's traded back to around $12 a share. So we've lost some significant gains that we had realized at the beginning of the year. And I think there's a number of dynamics that are going on. You can point to the easy ones. Hey, it's a new frontier. Hey, it's a new business model. It's complex. It's difficult to understand. Not a lot of comparables in the marketplace. The amount of capital resources in the institutional markets, the public markets that are going after clean energy investments is less now than it was a couple of years ago. You can point to all those things, but I think you need to look inside of Enernoc, and I think that's what we're doing. We're about to go to a strategic offsite starting Monday morning where we sequester about 10 of us for 3 days. And we're going to try to address some of the things. We call it, why is our baby ugly? Sometimes for a founder, it's really difficult to say, oh no, this baby isn't ugly. This is my baby. This is a pretty baby. But I've brought in, I know everyone's laughing, but it's really hard to do. And so I brought in some new blood to the organization. And in the past year, if you extend it a little bit further, you can even add another person. But in the past year, I've added a new vice president of human resources, a new chief information officer. I've added a new CFO. I've added a new vice president of products. All of these people have come from the software industries, from companies like Parametric Technology Corp, from Art Technology Group, I've added 2 new board members who have run companies like Endeca, Netezza, great software success stories. And I think what we've come to realize is we've got some of the things that challenge companies at our stage of growth, which is we've got customer concentration. PJM has represented the Mid-Atlantic grid operator, has represented
that's a huge
grid operator.
So if you're going to be concentrated on a customer, you want it to be big.
Yep, which it is.
And you want it to be solvent, which it is.
Both of those things, those things
but
are good.
nevertheless, I mean, taking a bit of a, I want to not call
Yeah.
it devil's advocate, let's call it investor's advocate point of view. It still looks on paper like, you're dominated by a
Yeah.
customer. So there's a couple ways to deal with that. Listen to me telling the
Yeah.
CEO of a company how to deal with it, but
No, please.
you can deal with it with product,
Yep.
or you can deal with it market. So tell us, are you pursuing objectives on either of those fronts? Either
On
with
both.
product? Okay.
Yeah. I mean,
We don't have much time, and I want people to be able to ask you questions.
No, but here's a couple ways to look at it. Just 2 years ago, when we ended 2010, if you looked at our international revenues, they were practically zero. If you looked at our non-demand response revenues, they were practically zero as well. You look at
I'm
where...
sorry, how long ago?
The 2010.
Okay, so quite recent.
Pretty recently. This year, our demand response, or our non-demand response revenues, demand response is the core business. Our non-demand response revenues will be about 15% of roughly $400 million. We're going to grow from about 280 to somewhere between 360 and $400 million this year. So that's $100 million of growth. Of that, 400 million, call it, we're going to have about 15% be from non-demand response. If you looked at our international revenues in 2010, practically zero. You look at where they'll be at the end of this year, it'll probably be $60 million or more.
Where geographically are we talking about?
So we've expanded to mostly English-speaking nations, with one exception in Asia. And the bulk of that is coming from Australia and New Zealand. And we were very deliberate over the last 5 or 6 years. We've been spending time with a partner there, eventually worked with that partner enough to realize we needed to acquire it a couple of years ago. They had a small piece of that 50 or 60 million already set aside, but organically we've been able to take that and grow it by 5 or 10x. So we're excited about trying to replicate that, because you only need to replicate it a couple times to really do something exciting. So we're going to talk about what are our international growth opportunities for demand response.
You mean in
in
this
particular.
Monday confab that you have?
Yeah, and for more than just that, obviously, but that's going to be the focus of it. And then I think it's also that product diversification. The business, we didn't mean to set about to create a demand response business. We wanted to create a business to help the commercial, industrial, and institutional user of energy manage energy better. We felt that you've got ERP, which is enterprise resource planning for the organization. You've got CRM, which is customer relationship management. You've got your business intelligence, or BI. And you can look at all those categories, and you can find mammoth companies that are doing CRM, be it Salesforce or Oracle or Siebel. When you look at ERP, you've got Oracle, you've got SAP, you've got huge companies. But and they're managing huge sets of data that are important for the enterprise. But when you look at the energy data inside the enterprise, you don't see those big players yet. They don't. You can't call up Oracle right now and say, I'm Coca-Cola Beverages, and I want to know exactly what I'm spending money on my energy expense. I want to tie it to my tariffs that I have at all the different utilities that I'm working with, and I want to know how I can lower that cost by 10 or 15%.
Okay.
That's what we set out to do, and I think now we're in a position to actually go about and do exactly that. We're bringing in 1.5 billion data points a month into our network operations center, and that data
Bringing it
needs to be
in
mined.
the course of your operating business.
That's right.
And of course, that's fodder for software or
So I think,
certainly for products, right?
I think that's exactly right. We're turning it around, and now the AT&Ts and Coca-Colas of the world that we have been servicing for demand response, and that we have been getting engaged in the markets, and we have been paying them to be a part of the demand response solution that we offer to the grid operators and utilities. We want to turn around and have AT&T and Coca-Cola paying us to give them that energy intelligence software, the EIS that is the ERP for those organizations.
Right. So if I'm writing an analyst note based on this conversation, I'm inclined to say, yes, it's still a DR-driven company, but there are initiatives afoot, and not only are there initiatives, but they're actually underway, and they're throwing off some revenue. But help me finish up this report by describing what is this company going to look like in 3 years?
Well, we, as a kickoff, a prelude 2 weeks ago to our management offsite, I asked the team, 10 other folks on the senior team, I said, I want you to imagine 5 years from now and just brainstorm, tell us what will this company look like. most of the executives in the room said, we will probably have half of our revenues will come from non-demand response. It'll come from our energy management solutions, the energy intelligence software. We will have thousands, tens of thousands, one person said millions of commercial industrial customers paying us to access energy data in a meaningful fashion to give them the analysis and reporting and other business intelligence inside the enterprise. That somewhere between 40 and 50% of our revenues will be outside of the US. So I think there's a big push on international expansion and a big push on the software part of the business where customers are paying us.
All right, so you're a technology company, no question about it.
Well, I got another stat for you that just if you're writing an analyst report, if you're a SaaS company these days, you're getting somewhere around 5 times revenues, maybe 6 times revenues. So our market cap today is about $400 million.
Yeah.
We have $100 million on the balance sheet. So our market cap is 400 minus the 100 on of cash, because that's just cash. You can say your enterprise value is about $300 million. I'm doing about $50 million worth of SaaS right now, or worth of SaaS-like business today. 50 million times 6 is 300 million. You buy Internoc stock and you get the demand response for free is what it comes down to. And demand response is a phenomenal business model at the end of the day. It makes sense. It's the killer application of the smart grid.
I mean, as an investor, I'm saying that's
great.
What are you going to do for me tomorrow?
I know. That's what we got to figure out.
Let's find out if there's anybody on the floor who has. Peter.
One quick one.
Okay. Okay, we got who's the lucky questioner? I think I see him here. Right? Their hand up.
When you take a look at the sources of energy you're dealing with, what changes in the grid would you want to be able to make your business more effective, and especially in be able to go ahead and designate energy sources for your customers, like future customers like AT&T, for example? There are a lot of contingent sources of power. Can you take those somehow with a gas turbine and raise those to a firm source of power and have a better product for your customers?
Yeah. It's interesting. I'm not sure that Internoc necessarily has a preference for what you just described. I do think, though, that the introduction of more and more renewables into the electricity grid and designing the markets and the infrastructure to support more and more renewables is going to be a great thing for demand response in particular, because I think the paradigm shift that's going on the electricity grid is really happening inside the system control room, the system operator at the utility or at the ISO. And what you're finding is they've been accustomed for decades to having one dial for one side of the equation, and that dial has always been on the supply side. I can fire this resource up or I can fire this resource down. The intermittency of renewables, or just the reality of renewables, is that's not the case. You can't fire up getting the sun to shine more or shine less, and you can't get the wind to blow more and blow less. And yet what happens is that resource, the resource that's at the peak or at the margin, that incremental resource where renewables play, renewables are making up an extremely high percentage of the amount that the system operator has traditionally been throttling in order to maintain real-time supply and demand balance. So it's not just that it's 5% of a system's resources. It could be more like 30 or 40% of the resources that grid operator is accustomed to being able to dispatch and throttle up and down in a meaningful fashion. That's a sizable shift in what's going on inside the system control room. So I think what's important is to change that paradigm where you're giving the dial now to the demand side. And I think there's a lot going on in the marketplace, not just with Internoc and other demand response companies, but you should be able to throttle demand up in order to balance supply and demand. You should be able to send signals that say, we want you consuming electricity right now, because that's the only way we're going to keep our system in balance, and that's the most cost-effective way to do it. We do have a project like that with Bonneville Power, where Bonneville Power sends us a signal, and we're paying our customers to use more electricity at that point in time in order to deal with a very short period of time where they have excess wind on the system. The more that can occur, the more valuable some of these other resources become that I think are important for our future.
So think about that. I mean, they're getting paid to increase demand someplace. Tim Healy, thank you for most.
Thanks so much.
Thank you both.